Welcome to the Leaders Insights podcast. Today's episode, IPO readiness, what it really takes to get there. Here's a number that should scare every founder listening. Most IPOs that fail didn't fail on listing day. They failed 18 to 36 months earlier. So why do CFOs still treat readiness like a countdown clock?
Because a countdown feels controllable, and the real work doesn't. Everyone obsesses over the roadshow, the 2-week tour where you pitch fund managers, as if that's the exam. It's not. The exam was the 2 years of homework nobody wanted to grade.
That sounds like the kind of thing consultants say to justify a bigger invoice.
Fair. So let me be specific. When Deliveroo listed in London in 2021, the shares dropped roughly 26% on day one. The narrative wasn't wrong. Food delivery was hot. What broke was governance. The dual-class share structure, meaning the founder kept outsized voting control, spooked the big UK institutions who wouldn't touch it. That's not a roadshow problem. That's a decision made years earlier that nobody stress-tested against the actual buyers.
So the contrarian claim is the narrative isn't the hard part?
The narrative is the easy part, and that's exactly why CFOs overinvest in it. Anyone can build a beautiful equity story. What they can't fake is the process of finalizing your financial results each month. That lands in 5 days instead of 25. Public markets want your third quarter numbers weeks after the quarter ends. If your finance team is still reconciling spreadsheets in week 3, you are not a public company. You're a private company wearing a costume.
How many companies actually have that 5-day close when they start the process?
Almost none of the ones who think they're ready. In my experience, when a company first says, "We want to IPO next year," their close is somewhere north of 15 working days, with manual journal entries, hand-typed accounting adjustments, everywhere. That's the gap they underestimate. They budget for bankers. They don't budget for the 18 months of unglamorous plumbing.
Give me the plumbing. What specifically breaks?
3 things, and none of them photograph well. First, your controls. The checks that prove a number wasn't just invented. Auditors will demand documented evidence for everything, and retrofitting that is brutal. Second, your forecasting. Public investors will crucify you for missing your own guidance. Or, acid, the earnings targets you set publicly. Miss twice and your credibility is gone. Look at Peloton after 2021. Guidance whiplash torched the stock. Third, the board. You need independent directors with real audit committee experience, and the good ones are booked. You can't hire that talent in a hurry.
You mentioned guidance. Isn't the honest move to just not give guidance and avoid the trap?
Cute. But the market punishes silence too. If you won't forecast your own business, investors assume you can't. The discipline isn't avoiding guidance. It's being able to forecast tightly enough that you hit it. Snowflake, the data company, built its whole investor reputation on beating its own numbers quarter after quarter early on. That's not luck. That's a finance team that knew its revenue mechanics cold.
What's the metric a CFO should obsess over that they currently ignore?
Forecast accuracy. How close your predicted numbers land to reality. Measured monthly, quietly, for at least a year before you ever file. If you can't predict your own next quarter within a few percent while you're private and nobody's watching, you have no business promising Wall Street anything. Track that variance like it's your resting heart rate.
And the vendors selling IPO readiness platforms? Skeptical or not?
The software helps with the plumbing, close automation, consolidation, genuinely. But their readiness scores are marketing. A dashboard glowing green doesn't mean an audit committee will sign off. Buy the tools. Ignore the certificate they hand you with it.
Give me the one thing a listener should do Monday morning.
Pull your last 12 monthly forecasts, line them against actuals, and calculate the variance. If you don't even have 12 months of forecasts to compare, that's your answer, and you just found your real timeline. Not next year, the year after.
Brutal and useful. Thanks for that. That's a wrap. Fresh CFO briefings drop daily at mba-training.com.